problem with investors is they want to be told before they start the journey that what you're doing is right and what you're doing is the best plan. That's wrong. I mean, what kind of justification is that? I mean, you take a risk in life, right? When you get married, it's a risk. How do you know your marriage is going to work? Who told you your marriage is going to work? You have to work on it. Who knows how good a parent are you going to be? You have to work on it. Who told you that if you join this business school, you're going to get a great job? No one knows that. So why do you need guarantees in investing? They need to be told, am I doing the right thing? Am I investing in the best strategy that there is? No, these are all. I mean, A to B, there are 1,000 ways to go. You pick one, and if you want change paths, it's fine. But do you have the conviction to do it without asking other people? Because other people will never get your perspective and your circumstances.
In the coming weeks of Let's Get Rich with Pattu, we have some super exciting stuff. I couldn't help myself. I'm starting this episode with a little teaser of sorts, Pattu, if you'll allow me. Pattu's been kind enough in the following episodes, not on today's episodes, to take us through a calculator of his, which is on the SEBI portal, which will make you aware of your life situation, if I could say it in that way. Financially speaking, of course. It'll be a gold mine for some of you viewers, as it will be for me. I can't wait for that episode where we start entering data and finding about where we sit and the basics of calculating and projecting and seeing where we are so that we can plan for our retirement. So that's an amazing episode coming up. Not only that, following that, Pattu's starting to get some really cool RIAs, which are registered investment advisors, onto our show, and we'll hear their stories. What is the process they use to help people plan for their retirement and their future? Amazing content coming up. But of course, before we reveal what this episode is all about, Pattu, hi, how are you doing?
Hi, I'm doing fine. I'm looking forward to this one.
Yes. So the last two episodes have been about rebalancing and of course, de-risking, Pattu. But there were a few loose ends that we wanted to tie up. Personally, in my mind, some feedback from listeners, etc., etc. For example, remember how we ended the episode asking you to help me convince my own head that, rebalancing or de-risking, let's stick to rebalancing for now, is worth it. There is proof of it. And I came up with this thought process, that's my psychology on myself, Pattu. Let me know if I'm right. But I said, if you don't rebalance, that amount of money is not real. And when you're in a real situation, you need real money, which is in fixed income. So I'm going to try and convince my mind with that kind of psychology, saying you need real money, which is only safe in a fixed income, which is why I'm going to start convincing myself that that's real money, that's not real. So I don't know if that holds any water, that argument.
Absolutely. I think it's a very sound argument.
Right. But not only that, I kept pushing Pattu for proof about what rebalancing is. And for the first time on the show, and if you're listening to us on an audio platform, don't worry, we've thought of you. We're probably going to be sharing a link, and we are sharing a link in the show notes below, which we urge you to click. This is a goldmine of information. These are charts, and for the first time on Let's Get Rich with Pattu, we're giving you some visual data that we encourage you to look at. And Pattu, if you can please talk us through it and tell us what this is all about as an overview.
So this graph is from one of my earlier articles on what are the benefits of rebalancing. And what I've done is taken Nifty 500 to represent equity. And I've taken a long-term gilt index, the IBEX gilt index, to represent fixed income. So we're going to have a kind of 60% equity and 40% fixed income kind of portfolio. And we're going to invest systematically in that for 15 years. And there are two situations. One is we start investing and we don't do any kind of rebalancing, which are the red lines in the, which are the black lines in the chart. And the other one is we do an annual rebalancing. Annual rebalancing is you reset the asset allocation every year, which is the simple way to do it. Of course, we have talked about doing threshold rebalancing, where you rebalance only after a 5% deviation and so on. But the results and the basic idea does not change much. So what you see in these four charts are rolling return runs. That is, I've taken a 15-year window, and that's from, let's say, April 1997 to when I did the calculation. I think I must have done this 1 or 2 years ago, so maybe 21 or 22. So I've looked at every possible 15-year period in this window by taking monthly data of the two indices. So in each of those red lines and black lines, you'd see approximately 300 to 400 data points. So
Wow.
every one is a 15-year run. So let's start from the top left. The top left, you have the return, the annualized return of the XIRR of the two portfolios. The XIRR without rebalancing is the black line, and with rebalancing is the red line. And you can see that they're more or less the same. Of course, visually, we get distracted by the red peaks. The red peaks immediately kind of ring a bell. So, oh, will I get more return with rebalancing? The answer is it depends. It all depends on the kind of sequence of returns that you will face when you start investing. That is the whole essence of the past performance disclaimer that mutual funds give you. So we can't say that rebalancing or not rebalancing will give you a better return. That is not the, and anyway, that is not the real purpose of rebalancing. Now, to understand why we need to rebalance, we'll go over to the top right graph, and there you see the maximum drawdown. So the maximum drawdown is defined as the maximum fall from an all-time high. So at any given point, if you can see that the market will keep moving up, it will reach one all-time high, maybe fall down, and then go to another all-time high, and so on. So we are going to look at the maximum fall from a peak, and that's the maximum drawdown. So if you look at these runs, the maximum drawdown when you rebalance the portfolio is significantly lower than without rebalancing. If you look at the portfolio without rebalancing, the drawdown has been minus 40, 43, 42%, and so on. And it has been much higher. That is it's a much higher negative number. So which means that the portfolio has dropped down more. Whereas if you rebalance, you are able to contain the drop in the value of the portfolio. And that is one way to measure risk. How much does your portfolio fall down at any given point of time? And rebalancing helps you mitigate that risk to a significant extent. And if you now go over to the bottom left graph, you have the standard deviations. So the standard deviation is a measure of what is the average deviation of the portfolio value from the average value itself. So let's say I have a set of numbers and I find the average, and I want to know how much individual numbers deviate from this average. And that is called the standard deviation. And if you look, the lower the standard deviation, the lower is the fluctuations in the value of the mutual fund NAV, or in this case, the value of our portfolio. And you can see that with rebalancing, the portfolio fluctuations are significantly lower, right? Not only is the fall from a maximum lower, the portfolio fluctuations on any given day is also significantly lower with rebalancing. And on the bottom right screen, you have the maximum number of continuous months the portfolio was underwater. So we say that the portfolio is underwater when the portfolio is below an all-time high. So if you reach an all-time high and after that it's not been, it's always been trading below that and it has never crossed that all-time high, then you say the portfolio is underwater. So how long continuously was the portfolio underwater? And if you notice that with rebalancing, this period when it was underwater is a little bit lower than without rebalancing, which means that the time risk is also handled well. So the value risk, which is the maximum fall, and the fluctuations, which is the volatility, as well as the time risk of being underwater, all these three are mitigated significantly by regularly rebalancing a portfolio. Sometimes you will get higher returns, sometimes you may not get a higher return, but that doesn't matter. But you must always remember, return is in hindsight. The risk is in the journey. All these returns that we calculate, that's always done in hindsight after the journey is done. But the risk is in the journey, and that is always important to handle and control so that we are emotionally in a good place. I want to go to sleep without worrying about my portfolio, and rebalancing ensures that. So that's the benefit.
Pattu, can I please, if if we were a crowd, you'd stand up and give you a standing ovation right now. This is a gold mine of information, right? And I'm going to try and summarize what you just said. Firstly, the amount of effort. So you're saying you took a 15-year window from all the data and then you kept moving it by a month so that you had so many 300 to 400 data points. So clearly, this is irrefutable evidence, right? In all four charts, the red line is doing better. You can't argue with this data, and therefore, one line proves that the standard deviation is much less, and therefore you're hugging that line as you grow towards your corpus. One shows that the number of times you spend, number of months, or amount of time you spend underwater is much less if you rebalance. I mean, you can't argue with this data. So thank you so much for that. I no longer need any psychology to convince myself this is it. This is a gold mine, and we cannot appreciate it enough. So thank you, Pattu. I have one small question. How come both lines towards the end are close to each other? What does that show?
Yeah, that is essentially the sequence of returns at play here. So everything is cyclic in the market. So sometimes, for example, let's take SIP investing versus lump sum investing. This is a very standard argument that people have. Many people will say SIP is always better and so on. That's not really true. There are certain market sequences or market periods where the lump sum would do better, and there are certain periods where the SIP would do better. So similarly, the benefits of rebalancing or the quantum of the benefit will also fluctuate depending on the market cycles. So our market history is quite limited. Although we say I've taken data from 1997, that is just a small period. Like 20-30 years is nothing. You have to.
It's not even one person's journey towards retirement. Yeah.
Correct. So we will have to go through more cycles to understand how these benefits will fluctuate. But it is very clear that you always get a small benefit, whether the benefit is, it's non-zero. And that is enough for me. And you can't predict how the future will be. See, when you start investing, you can get the maximum benefit that you see here or the minimum benefit that you see here or anywhere in between. But you get it. And that should be.
And those words you said, right? You can sleep with a peaceful sleep, knowing that you don't have to constantly track it and worry about these massive falls if you're only in equity. So thank you so much. I mean, this part for me has been one of the highlights in all these episodes, but to really, really appreciate it.
Thank you.
Moving on, we wanted to do a bit of an experiment. It's kind of philosophical. It's definitely fictional because these are not real people, but we thought we'd do this, Pattu. It is the Amar, Akbar, Anthony experiment, right? Where Amar is a 25-year-old, Akbar is a 35-year-old, and Anthony is a 45 to 50-year-old. And we're doing this experiment to try and see whether this represents our audience, the people listening to us, and the different stages of the journey they're in. So what I'm going to do, Pattu, if you don't mind, is I'm going to read out each person's story, 2 or 3 lines or life situation they're in. And if you can tell us what the problem is in what I just read out and what they should do to correct it, Pattu, right? So I'm going to start with Amar, a 25-year-old who has been investing for, say, 1 or 2 years, just begun his process. He's very equity heavy. He's invested in 8 mutual funds, 6 of which are hybrid funds. He doesn't want to bother about rebalancing later. He says the fund managers will do it for him. After all, it's a hybrid fund. A few stocks too in his portfolio. He loves stock investing, right? This entire joy or this adventure of stock investing that it brings to him, mostly in mid caps, and he's in search of his multi-baggers. How would you address Amar, Pattu?
Well, he's got the age to live and learn. That is the first point. So the basic idea is that you say that, look, I want to invest in a hybrid fund, which will hold anywhere between 65% to 80% of equity at any given point in time. And you claim, look, that's my portfolio. I don't need fixed income separately. And I'm not holding 100% equity. The fund manager anyway is going to rebalance the portfolio every month, every quarter, depending on his mandate and market conditions, etc. So why should I bother? The problem with that is if you actually sit down and calculate the risk associated with a aggressive hybrid fund and compare it with a diversified equity fund like a large cap fund, mid cap fund, whatever, sectorally diversified fund, there's not much difference. There's a very
Hmm.
small gap, right? If the diversified fund risk is there, the hybrid fund risk is there, the aggressive hybrid fund risk is there. There's not much. So it's essentially a equity fund that you're investing in. It's okay to do it at 25, but as you age, you notice that the fluctuations in the portfolio value, which we just saw in these graphs, they'll be significant. They'll still be significant. So I would recommend, that's fine for now, but I would recommend adding fixed income, adding some fixed income to bolster the portfolios to kind of reduce the volatility down. So
Sure.
diversification is basically the only free lunch in finance, or in the world, if you would. Just by adding a little bit of fixed income to the portfolio, you can significantly reduce the fluctuations. And so it's okay for now, but I think going ahead, some fixed income would help.
And how about if somebody asks that, is there a hybrid fund with 50-50 split in equity and fixed income?
See, the problem with that is it would be taxed as per slab currently, if I'm not wrong. There are some changes in the tax, I keep forgetting. Oh no, it would be 45%. So I think that if I'm not wrong, 45% is the cutoff for equity. Below that, if a fund holds below 45%, it will be taxed as per slab. Between 45% to 65%, it will be taxed at 20% with indexation. So the mutual fund industry is still trying to get into get grips with this, because these changes were made in February. We still don't have any viable options for things in the middle, but you have to pay more tax. So most people don't like that. So they would like that equity where you have that 1 lakh tax free capital gains, long-term capital gains, and so on. It's possible. I think if the funds do come, it's fine, but I don't think there are viable options as of now at the time of this recording.
Fair enough. And something that has just popped into my mind, which was part of our question, I thought this is a nice time to ask it, is suppose we are convinced about rebalancing, and I hope a large majority of our listeners are, right? And we want to keep rebalancing, or even if it's once a year, twice a year, I want to take a large chunk of money, say twice a year, from my equity into my fixed income. What are my different options? Do I just keep buying fixed deposits? Do I buy debt mutual funds? What do you recommend?
So for a long-term portfolio, I think fixed deposits are very difficult to manage, because you have to break them, open them again, and so on. It's painful. And of course, tax-wise, they're also kind of poor, because whether you are redeeming them or not, you have to pay tax on a fixed deposit.
Yes.
Whereas in a debt mutual fund, you don't need to pay tax until and unless you redeem. And you can redeem in part. If you have 1 lakh units of a debt mutual funds, you can redeem even 1 unit. You can't partially open a breakup FD. It's all or nothing, right? Of course, there are flexi deposit funds, but they're more saving products. They're not long-term investment products. I would say a debt mutual fund is still the way to go for a long-term investment. There are many different options when it comes to a debt mutual fund. But the problem with the debt market, and I think we should probably make an episode of this, because investing in debt funds are much harder than investing in equity funds. You would think, okay, it's just a bond, right? I mean, I pay you money, you pay me interest. It's a bond, that's it. But the problem, when you start trading the bond midway, lots of things happen.
For the mutual fund, right? Not for us.
Yeah, and for us, both. The science of trading bonds is very complex. A lot of things can happen, and we should probably cover this at some point.
No, absolutely. I mean, number of questions popping in my mind right now. For example, we know how a equity mutual fund works. They buy the stocks of these same companies. But how do these debt mutual funds work? What do they invest in? What are their cycles of investment, etc., etc.? So yes, but you hit upon a very nice idea for our next episodes.
So I think it all depends on how comfortable you are with debt products. Many people, they are comfortable with debt funds when the FD rates are low. So a couple of years ago, interest rates were very low. FD rates were like almost touching almost 6% or below 6%. Then they said, oh, debt fund. Now, if you notice, the cycle has changed. Now, debt FDs are giving you comfortably
7 plus, right?
7+%, of course, before tax. But now nobody wants to touch a debt fund. And of course, we've had the Franklin crisis
Absolutely.
during the COVID time, and that kind of almost shut down a huge market. So, but I'm a strong believer in debt mutual funds. There are many options like gilt funds, corporate bond funds, conservative hybrid funds, and so on. But for a newbie who is getting started, I would say get used to the lower end of the debt segment, that is the lower tenure, bond tenure, where the bond duration is very short, the liquid fund, the money market fund, and so on, where the NAV is more or less going to keep moving up, and there will be no huge spikes up or down. So a liquid fund or a money market fund is a very you can use it for short-term goals. For example, for your children's education, if that's a 10-year, 15-year goal tops, right? So you can gradually shift money into a money market fund or a liquid fund. Or there's something called an arbitrage fund. That's an even more complex idea. But so these are the kind of options you can push from equity to fixed income, which are slightly more tax efficient than the fixed income products.
Would you like to name any of these funds, Pattu? Because I remember I'm drawn back to one of our earlier episodes where you said when you're selecting the Nifty funds, any of these big Nifty funds are fine as long as their AUMs cross 1,000 crore, and most of them are. How does one select, or maybe that's part of the next episode we're doing on debt
No,
mutual funds?
see, liquid funds and money market funds are quite fine. You just pick up an established AMC, SBI, ICICI, HDFC, and just choose their money market fund or liquid fund. You're done. I mean, that's good enough. Just to quickly do it. But if you want to explore corporate bond, gilt, or conservative hybrid, you need to slightly do some effort. Not only I'm not talking about analysis of returns or risk. You should first appreciate the kind of risks. And one thing I want to make it clear is the best place to understand every possible risk in the universe is the scheme information document of the mutual fund. Of course, you will get real scared when you read it, but that's where you understand all these things can happen. I'm not saying they will happen, they can happen. And that's how you learn. I mean, you slowly understand risk. People talk about risk appetite, and that's probably another episode. I have a large risk appetite. I have a small risk appetite. That's a problem, because risk appetite is equal to risk awareness. How much do you appreciate risk, right? And so maybe we should talk about it separately. But yeah, you should understand risks. That's what.
What a great line. Risk appetite is equal to risk awareness. I'll remember that one. All right, quickly back to our experiment of Amar, Akbar, Anthony. Akbar is 35 years old, Pattu, who has been investing for 10 to 12 years, has a good 20 years to retirement, right? But needs to start getting serious about it now. While he does want to have a 50-50 allocation in debt and fixed, he only wants to shift some of his fixed income to equity. He plans to achieve 50% equity allocation only with new money earned and saved. His reason being that his fixed income corpus amount is so high that in case he witnesses long periods of zero income, the interest earned from fixed income is good enough for him to at least survive.
Yeah, this is a tough one, and many people are in this boat. I know a lot of people. See, it's so difficult to get out of the lure of fixed income. I mean, they give you 7%. I know it's nice money, and you see it compounding every year. Example, EPF, although they don't pay interest on time, it's still such a wonderful thing to have. It hits your bank account, and you feel happy about it as if you won a lottery. The point is that you should look at it's fine to do it. I mean, after all, at the end of the day, we can't do anything which is against our personality. We can't ask a person to shift whatever you can from that fixed income and put it into equity, because the day after you shift, something will happen in the market, and then you will feel a huge sense of regret. So that won't work. I think you have to adjust the way we invest gradually. So yes, I think starting to invest in the right fixed income, the right asset allocation going forward is fine. It will work. However, you should also do a proper retirement planning calculation and find out how much corpus do you need, how much do you need to invest. And I would recommend gradually increasing the equity allocation in the coming months. So let's say you want 50-50 and you say, I have 1,000 rupees extra and I'm going to put this 500 into asset classes. But I would say after you get used to the equity market fluctuations after a few months and so on, you gradually start increasing the amount you invest in equity so that you can, compensate for the asset allocation part a little bit.
Sure. The two things coming to my mind, Pattu, is one, you had said that these people with very high fixed income, allocation will take so long to reach that 50-50. I mean, how much will you invest in equity if it is a few months? It'll probably take years to reach that amount, right?
It will be a lifetime.
And then there's the risk of not taking risk. I remember that line of yours as well. So perhaps those are the two things we should leave Akbar with.
You will have to find a balance. It's hard, but that's why you need to plan and you need to understand, am I risking more by not taking risks?
Yeah.
Like you said.
And as you said, do a proper retirement calculation. Then you'll understand how much you need to either catch up or, be skewed towards equity. All right. Final example of Anthony, a 45 to 50-year-old who is now in the crunch phase with little time to retirement. Anthony didn't know about investing until his 30s, which, is a great example of many of our viewers and listeners. So started late, has 30-70 or 40-60 debt to equity, but it is just coincidental. Anthony hasn't rebalanced ever and has no de-risking strategy. His plan is to pump as much as he has into equity via mutual funds and stocks till he retires and then pull it all out, dump it into FDs, and buy a pension plan which starts immediately. His costs are rising steeply too with his 2 kids. So investing money is also a strain.
So I think we should understand that pension is only going to be one component of our retirement portfolio. I'm not saying pension is not important. Pension is important, but it's just going to be one component of it. We also need a significant corpus that will help us mitigate inflation in retirement or sudden expenses in retirement. So I don't know how much the corpus here is, because people say, I have 90% equity. I know investors who say I have 90% equity or I've got 45% returns, but the amount is actually very little. So those things don't matter, right? What matters is the actual value. What can you do with that corpus today? And you have to be a little careful going all out in equity in the intervening period from 45 to, let's say, 55 or 60, because we don't know how things are going to be. Like I said, a hung election, a couple of bad years, and your returns are going to be very poor. So you got to be a little careful about it. And the other point is that the pulling all out from equity, going from 100% or let's say 70% equity to 0% equity after retirement is also an extreme thing, because we need 20-30% of equity typically. Of course, that depends on the corpus, assuming the corpus is reasonably large. So that also is necessary. So I think we should not do anything extreme. Again, a proper retirement calculation. And maybe if that warrants increasing more in equity, yes, but you must understand that returns are not guaranteed. Because the problem is that no matter how many disclaimers we have, many people believe that all they have to do is stay invested over the long term and they'll get returns. There is absolutely no proof of that. I can give you numbers which tells you. I fought with a very intelligent guy, unfortunately, on this very point. He was, gung-ho about all this. We say economy grows, returns will grow, and etc. etc. There is absolutely no proof.
I think this is going to become a social media meme, Pattu, if you take that little clip and make a promo video out of it. But yeah, I think a lot of people need to hear that. I don't want to say brought up, but I have been hearing incessantly, just stay invested, invested in equity. That's the one sure shot for retirement. And this is so sobering and real, and especially those graphs at the start. So let's end this episode, Pattu, on a few quick questions. Thank you for Amar, Akbar, and Anthony's responses. There are a few real questions that have come in from our listeners, and if you can speed through them. This one's from Dheeraj Sharma, 1036. My retirement is 25 years away from now, and I'm starting with 70-30 equity debt portfolio. Is it fine if I have this 70-30 allocation for first 15 years out of my 25 years goal duration, and then from 16th year onwards, I start decreasing the equity by 5% a year, and of course, correspondingly increasing debt, which is kind of perhaps come from the episode we had on de-risking?
See, in principle, that's fine. Now, this person wanted an answer quickly, so he had written to me also the same. So or maybe on Twitter, I asked him, for the first 15 years, if your returns are 0 or negative, what will you do? And he said, I'll panic. So the point is that we must understand that, okay, you have a plan, but you must review the portfolio once a year, and we must not hesitate to change the plan. If things are not going well, fine, we chuck it. If you invest for 6-7 years, maybe equity is not doing well, reduce your equity allocation. It's fine. What will happen is, of course, the market will zoom after you move up. But that's fine. It's done. You can't do anything about it. You have to protect your portfolio. And when I say protect your portfolio, what I mean is, I had talked about the projected growth of the portfolio and where your portfolio is today, the fluctuations. And we need to protect the fluctuations in those in the actual portfolio and keep it as close as possible to the target portfolio. And it doesn't matter what asset allocation you use as long as it's close. So if things don't go well, you must have the confidence and the conviction to change the plan. As long as you have that, you can do it.
I think the basic answer is, even when you do a retirement calculator and you come up with a plan, you can't have a 15-year plan and have no changes during that 15 years. I think that is the main answer, right? Review it every single
Redo the calculation once a year.
Next question from Vishwanath Kuruva. Do we need to invest in separate funds for each goal? Pattu, this is a question very close to my heart. Equity and debt, so that it will be easy for redemption on goal maturity. Any specific rebalance strategies to follow in this case? I think the first part of the question is the most important. For example, I have my kid 1 education, kid 2 education, my retirement corpus, etc., etc. Are these separate portfolios? How does one deal with these separate financial goals? Pattu?
So you can, I think that would probably be an episode in itself, but briefly, there are 2 ways to do it. One is, you take all your long-term goals and put it in one basket. And the short-term goals, you can manage separately. The asset allocation is not of too great importance in the short-term goal. Most of it is going to be fixed income anyway. So that's the unified approach. Or you can have the separate individual portfolio approach. And I use the individual portfolio approach. My retirement is 65, which is another 15, 16, 17 years, 16 years away. But my son's goal is about 5-6 years away. It was a long-term goal when I started, but now it's not that big a long-term goal. So I have separate portfolios for them. It's easier visually for me to say XYZ funds are this goal, ABC funds are for this goal. I redeem this, I don't touch that, and so on. Some people, what they do is they open a different portfolio in the same fund.
Yes.
That's one way to do it. But that works great when it's an index fund, because the chances of you shifting from an index fund are low. Whereas if you chase 5-star rated funds, and if you open 3 portfolios there, after 2 years, it will be a 3-star fund, and you say, oh my God, I want to shift from there. It will be a mess. Whereas in my case also, I have active funds, but they're different active funds. So overall, it's some kind of diversification among the funds by having 2 different goals. That's one way to do it. The point is, I hate this idea that this is better than that. Because the problem with investors is, they want to be told before they start the journey that what you're doing is right and what you're doing is the best plan. That's wrong. I mean, what kind of justification is that? I mean, you take a risk in life, right? When you get married, it's a risk. How do you know your marriage is going to work? Who told you your marriage is going to work? You have to work on it. Who knows how good a parent are you going to be? You have to work on it. Who told you that if you join this business school, you're going to get a great job? No one knows that. So why do you need guarantees in investing? They need to be told, am I doing the right thing? Am I investing in the best strategy that there is? No, these are all. I mean, A to B, there are 1,000 ways to go. You pick one, and if you want change paths, it's fine. But do you have the conviction to do it without asking other people? Because the other people will never get your perspective and your circumstances. So anything goes as long as you can handle what you're doing. If you know what you're doing and if you can handle the two portfolios, it's fine. So
Amazing. There's one guarantee though, that if you ask a question on Let's Get Rich with Pattu, it will get answered with the utmost brutal truth. We love that about you, Pattu.
even if it means I don't know.
Here's a tough one. Perhaps to end this episode, we had others, but I love listening to Pattu, sir. I'm a poor government employee, somehow managed to make ends meet. Kindly make a video on how to be financially free for government teachers with low salaries. I know my mother will really, really feel this one. So, how do you respond to a question like that to end this episode?
It's a real hard one. There's a saying in Tamil called Veraliketa Vikam. What it means is, it says, if you have a swelling on your pinky, it will be proportionate to the size of the pinky. It will not be proportionate to a thumb. It will not look like a swelling on a thumb. The swelling on a thumb will be much bigger. Right? So what that means is, if your salary is only that much, you have to dream only that much. You have to aspire that much. You live within your means. You stay out of unnecessary debt. You can't say, my friends, we all study together. My friends are all earning more. I'm here. I'm stuck in this. So I want to, spend like they do. You cannot change your social station by spending. You can only change your social station by investing and not spending. So, it's very hard to tell people not to aspire. You can't have a car. Maybe you can never ever have a car. You can never ever have maybe an iMac or something like that. Whatever, maybe even an independent house. So all you can do is live within your means. Whatever extra that you can spare, invest it. That's the most pragmatic that you can get, but it's very hard.
I can say two things, Pattu. One is, you are the foundation on which this country is built, teachers, right? You contribute to society like nobody else. One is, I'll tell you the example of Pattu, who is a teacher himself, who is financially independent, right? So perhaps try and follow these rules, or try and follow this thought process and this philosophy. And number two, learning is the number one thing that seems to be working in the media world today. Try and upskill or use your skills to let other people learn, right? Turn your skills into a course online. Start a podcast like us, right? Not that we're making money from it, but yes, try and figure out other ways to use your skills to create more income. Listen to Let's Get Rich with Pattu, and I'm sure the future will be bright.
Can I just intercede there?
Sure.
I think not all school teachers are the same.
Of course.
Not all teachers are the same. Excuse me. Some teachers get paid way, way more, and unfortunately, I'm one of them. So my example is more of an exception rather than the norm, and so you can't look at it from my point of view. So the way I look at things is very different. But for a person who is teaching a school, or maybe a college which has got no research component and so on, the salaries are very poor. The work hours are extremely long. So it is hard. It is extremely hard, and I'm very sorry. The only way you can get anything done is by aspiring less.
Yeah. Or creating new income streams, which is very possible, right?
Which is very tough, but yes, that's something to look up to.
All right. On that note, let's call it a close, Pattu. Very special episode. For the first time, we experimented with the visual medium, and what a visual medium it was, right? A goldmine of information, proof that rebalancing and derisking makes sense. It is proven with backtested data, over 300 and 400 data set points. Pattu, thank you so much. We'll see you on the next episode. So much to look forward to. Please keep sending your question in, viewers and listeners. We are nothing without that. Like, share, and subscribe this video. And we'll see you next week. Pattu.
Thank you. Bye bye.